All right, guys, welcome back to the channel. Today, I wanted to talk about Jeremy Grantham's prediction, as well as just other perma bears, gold bugs, so on and so forth. So here are the headline, and it's been going around a little bit today. Jeremy Grantham predicts the U.S. super bubble will pop, wiping out 35 trillion in stocks and housing. Here are the 11 best quotes from his new note. And with this, he's saying maybe a 45% decline in stocks, and that it's already begun. So just a sense, people like Jeremy Grantham, Nouriel Roubini, Nassim Nicholas Taleb, Peter Schiff, who else is out there? Michael Burry is another one. Just gold bugs, perma bears. The end is coming. The end is near. They sort of view themselves as Cassandra from ancient Greek tragedy, who was someone who foresaw the future, but her curse was that no one was to believe her. So she would go around saying, "This is about to happen. This is about to happen," but no one would believe her. And so there you have it. So I think they view themselves in a way as kind of martyrs, as Cassandras. If only the world would listen to me. Kiyosaki is someone also in that realm. He's predicting. I think he predicted the greatest crash ever in October. Well, we're past that. So maybe he's going to say I'm a few months off. But these people are always there, and they're always predicting market crashes. Again, the end is nigh. But when you look at the long-term historical returns of the stock market, those who ignore them and kind of follow Warren Buffett's advice or Jack Bogle's advice, essentially to turn off the TV, turn off financial media, and Warren Buffett says, including me. And so I would even say, including what I'm talking about here, and just have a long-term view, a buy and hold view on certain long-term indices, you're going to do quite well. You're going to have volatility at times, but to quote Jack Bogle here, don't peek at your account statement. But let's get into what Grantham is saying here. And he says, there's 11 points. We'll go through them. The U.S. is in a stocks, housing, and commodities super bubble. Let's pause this here. Okay, so let's scroll. Here we go. Today in the U.S., we are in the fourth super bubble of the last 100 years. The other were in stocks in 29, 2000, and housing 2008. The equity bubble has now been joined by a bubble in housing, an incipient bubble in commodities. In a bubble, no one wants to hear the bear case. It's the worst kind of party pooping. For bubbles, especially super bubbles, where we are now, are often the most exhilarating financial experiences of a lifetime. The final feature of the great super bubbles has been a sustained narrowing of the market and unique underperformance of speculative stocks, many of which fall as the blue chip market rises. They occurred in 1929 and 2000 and is occurring now. So what I'll say here, and I'm going to get to this in the second part of the video, essentially, is I would agree with him here that, as speculations run rampant and then they subsequently fall, a lot of that capital goes into more value-oriented blue chip dividend. I was talking to someone the other day, and they mentioned to me, I think that in 2000, when the tech bubble faltered, that small cap value returned in excess of 20 or 30%. So it's kind of what he's saying there, that when capital flees one sector, it often hides out somewhere else. And it's not always in just pure cash or in treasuries. It can go into other sectors. So that's interesting. That's something I would tend to agree with. And that's kind of the second part of the video, where I'm going to showcase some individual stocks here that look to me and to the software I use, FASTGRAPHs, quite undervalued. The most important, hardest to define quality of a late stage bubble is in the touchy-feely characteristic of a crazy investor behavior. But in the last 2.5 years, there can surely be no doubt we have seen crazy investor behavior in spades, especially in meme stocks and EV-related stocks and cryptocurrencies and in NFTs. When pessimism returns to markets, we face the largest potential markdown of perceived wealth in U.S. history, Grantham said, mixing Three asset bubbles together is extraordinarily dangerous, and said the S&P could drop by 45%. I don't see that, and I'm going to get into that again in the second part. I just want to go through all his 11 here. I see it if there's a pullback, just a kind of garden variety bear market. And so mark that down. Grantham is saying 45%. I see us in that 20 to 30% if we go into a bear market, which I don't even foresee as 100% certain. We're going to get into the S&P is trading at 23 times earnings, 24 times earnings. If it goes back to, let's say, around 18 times earnings, you're looking at a 24, 25% pullback, not a 45%. Maybe he'll be right. Again, no one knows nothing, to quote Bogle. So maybe Grantham's right and I'm wrong, but that's just how I personally see it. The valuations across all these asset classes return even 2/3 of the way back to historical norms. Total wealth losses will be on the order of 35 trillion. All of the economic and financial dangers that are now building up from multiple major bubbles do not appear to be considered especially dangerous by the Fed or most of the equivalents around the world. So he's kind of saying the Fed and investors themselves are underestimating where the market is. With the clear dangers of an equity bubble revealed in 2000 and 2002, the even greater dangers of a housing bubble in 2006 and 2010, and the extra risk of doing two asset bubbles together in Japan in the late 80s and the US in 2007, what has the Fed learned? Absolutely nothing, or so it would appear. So again, kind of criticizing the Fed. The Fed's asleep at the wheel. It hasn't really learned from past bubbles, past market crashes, and it's doing itself, society and investors a disservice from its actions or non-actions, or ever how he sees it. And we're almost there to the 11. Avoid U.S. equities. Emphasize the value stocks of emerging markets and several cheaper developed countries, most notably Japan. Speaking personally, I also like cash for flexibility, some resources for inflation protection, as well as a little gold and silver. So that's an interesting one, and I would agree with him there. As someone who has a bent towards value investing and value stocks, particularly, I'm going to talk through some specific names that I'm interested in, and you might be interested in as we go through this. Again, guys, remember, I'm not a financial advisor. I'm just explaining to you what I'm personally excited about investing in and looking at. You have to do your own research. But right now, I also saw that someone had said that, China is trading at 11 times earnings. We're at 24 times earnings in the US, in the S&P, 23, 24. So, there's an opportunity there. People really talk about Alibaba, particularly in China, because of the sell-off. That's something that is trading at modest multiples. Gold, silver, inflation protection. You can look at tips, precious metals, some cash, I think he talks about. The other thing is with Russia, and I'm going to talk about Sberbank. I did a video on Sberbank several months ago. Obviously, with China and Russia, you have geopolitical risk. If Russia invades Ukraine, what's going to happen to Russian stocks? They've sold off tremendously on the anticipation of that. They're trading at very modest multiples. Great dividend payers. So that's something to look at. And the last one, cryptocurrencies leave me increasingly feeling like the boy watching the naked emperor passing in procession. So many significant people and institutions are admiring his incredible code, which is so technically complicated and superior that normal people simply can't comprehend it and must take it on trust. I would not. So that's an interesting divergence here, because, even within perma bears and doom and gloom types or anti-equity types, a lot of them talk about Bitcoin as a place for refuge. So like Kiyosaki is a big Bitcoin guy. He's also, the biggest market crash is coming, but he's saying he's interested in gold, silver, real estate, Bitcoin. Grantham, also a perma bear, and right now someone that's not interested in U.S. equities, thinks it's overvalued, thinks Bitcoin is, to quote Charlie Munger, rat poison, essentially. So you can even see the differences. Personally, I don't think Bitcoin is rat poison. I don't think Bitcoin is going to zero. I think cryptocurrencies will be part of the future along with NFTs. Will there be volatility? I think Bitcoin today is selling off. It's at 38,000 or so right now as I'm making this. So, obviously there's volatility, but I think Bitcoin will be part of the 21st century as opposed to Grantham. So let's get into some of this now. Let's shift over to FASTGRAPHs. And I think this is an important tool. And I use a lot of different software. You guys know I use Composer for my quantitative style investing. I'm just going to shift the camera. There we go. And I use Zacks. I use Guru Focus. I use Seeking Alpha. I use FASTGRAPHs. I really like using screens and software to kind of see where things are on a metric based analysis and a database analysis, instead of following just gurus, instead of following like, well, this person's opinion. Let's look at the data and see what the data says. So here is from FASTGRAPHs, and I'm a big fan of Chuck Carnevale of FASTGRAPHs and this software. And you can see here it's showing it was on December 10th. It was at 25 times earnings. It sold off January 20th here, 23.96. And you can see here, I'm going to put my cursor, normal P ratio is 18.4. Sort of the Graham-Dodd fair market value is 15. But if you go from where it is here, 4482, 23.96, to here, 3426, and a P of 18.43, it's about a 24 or 25% decline, which again is a garden variety bear market, 20% or less decline. I'm seeing in that 20 to 30%. And I'm not even convinced that we're going into a bear market. I'm not even convinced personally that we're going here to here. We'll see. We'll see what the future holds. I mean, everyone else, perma bears seem convinced that it's inevitable, that we're certain that the end has started, the end times, this is the beginning of a sell-off. Or is this just a little correction? So this is where the S&P is now. This is based on historical data. Take that for what it is. That would be about 24, 25%. But let's actually go, and I want to quote, and I always quote these things. I probably repeat myself too much on these two quotations. And the first is from the founder of FASTGRAPHs, Chuck Carnevale, and he says, there's no such thing as a stock market. It's a market of stocks. So when people say the market is crashing, or the market's going to have a big pullback, or so on and so forth, you really have to look at individual companies as opposed to overall market. Now here, I'm contradicting myself because I'm looking at the S&P 500 just to get a sort of a bird's eye view sense. But when you're making selections on stocks, I think you want to look at them individually. And then the other is from Warren Buffett, and it dovetails nicely with Carnevale's. And he says, the market is there to serve you, not to guide you. So when the market is about selling off here, people think, oh, it should be guiding me to sell, sell, sell. Whereas when it's selling off, it should be serving you, looking for things that are on sale, looking at valuations. So let's start. I'm going to look at 7 different companies. A lot are in financial services, and this is one, Unum, that I've liked for a while. I own it. And I own probably, I'd have to look at my portfolio. I think I own all of these, to be honest. So let's look at the first here. Let me just bring my screen down just a little. Okay. So again, this is Unum. This is the normal PE. This is the sort of the fair market value PE, but this is what it normally trades at. And you can see ever since 2018, Unum has kind of been on sale. So big divergence, trading at 6 times earnings, normally trades at 9. Earnings per share yield 16%. Your blended PE of 6. Look at its dividend yield. It's dividend yield. So this is what I call a Maneosian. Just for those of you to refresh, a Maneosian is where the ratio between the dividend yield and the PE is 2 or under. A super Maneosian is when the dividend yield is greater than the price to earnings. It means it's been kind of discarded by the market, by Mr. Market, to quote Benjamin Graham there. So there's Unum. You can see that's on sale. So even if Grantham is right, and he does make that point to his credit, that in situations like this, a lot of times people move from these bubbles. So say it's like sort of Cathie Wood, tech kind of companies, SPACs, into companies like Unum, and they really burst up. Remember again that small cap value on 2000 had a positive return. So let's go Goldman. Jim Cramer has been been on Goldman the last few days. I think he's absolutely correct on this. I mean, you got Goldman Sachs trading at under 6 times earnings, with its earnings per share of 16, its dividend yield 2.30. I mean, look at the gap between its normal PE ratio and here. It's huge. It's massive. The divergence here. So, again, is it a Maneosian? The way you figure that out is you take 5.96 divided by 2.3, 2.59. So it's not technically a Maneosian, but it's fairly close to it. It's 2 and change. So there you go. I mean, even if there's an equity bubble, I mean, what is Goldman going to sell off even more and trade at 3 times earnings, at 2 times earnings? And if it does, you have a dividend yield that's going to increase as the stock falls, and you're going to then take those dividends and buy cheaper Goldman and just compound. So, that's a place. Again, you'll find a lot of these in financial services. I own, I think, all of these. MetLife, here again, look at the difference between, you got a P of 7.9. It normally trades at 10.29. So you get a nice divergence here. And again, ever since about 2018 or something, it was really at a discount. I think this is when I bought it. I'd have to check in 2020. Huge divergence there. So again, we're going to come here. So let's go Met. Let's go Prudential. I'm just doing these briefly so you can do a deep dive into all these companies and pull them up on Zacks and Seeking Alpha and so on and so forth. But again, you have Prudential, blended PE of 8, dividend yield of 4.09. So 8.08 divided by 4.09, 1.97. So this would be a Maneosian. Again, you have that nice margin of safety here. Okay, let's go to the next one. And this is one, you guys know, he was on camera with me last week or so, Logan. He had written about CVS a while back. I think it was his number one choice, if I'm not mistaken, in 2020. And again, that would make sense because in 2020, look at the divergence. Now, it's run up a little bit. You see it here as it was trading at 59 in 2020. It's now gone up to in the 900. So it basically doubled. But again, with FASTGRAPHs, when you're looking at screens like this, look, you can just see this in 2020 that, where it should be. Now, there's still margin of safety. So this is something still, that's undervalued based on this metric. And we're going to go, Jeremy Grantham mentions looking at emerging markets, looking outside the US. This is something I came across on Seeking Alpha's quant screens and a lot of screens on Zacks. So what I do is when I find that something's showing up on a value screen on Zacks or your Refocus, it's also showing up on Seeking Alpha. I'm like, there's patterns here. So PetroChina, obviously have the geopolitical risk with China and the US. But look at the gap here to here. I mean, it's trading at 5.91. Looks like, and it's normally trading at 13.21. Big gap. And you almost have a super Maneosian because the dividend yield is almost greater than the blended PE here. And we get 2 more here. And again, I'm just showing you that even if all these people, even if Kiyosaki, people like Rubini and Grantham, and even I think Carl Icahn came out and today or yesterday, and these big sort of public intellectual types like a Taleb, Nobel Prize winning economists like Rubini, multi-billion investors like Grantham come out. It doesn't mean that there isn't value somewhere in the market. And so here again, this is AllState. This shows up on a lot of my value screens as well. So, and then the last one, again, Sberbank, I did an article or a video about it. If you look on my channel, I did a video about it a while back. And again, my friend Logan just did an article on it as well. Certainly you have the geopolitical risk, but look, you're trading at 4.43 times earnings. It normally trades at what, 9.34. And you have, this is one where you have a definitive super Maneosian. The dividend yield is greater than its price to earnings by a lot. You know, even if a dividend yield were 8%, it would be essentially a super Maneosian based on the metrics here, or 9%. Is it 12%? So again, though, what if Biden? I'm going to bring my screen up now. You know, disallows any individual or LLC investors that are based in America from owning Russian stocks. What if it's delisted? What if they freeze the Russians out of the banking system? So there's a lot of geopolitical risk there, which is why I think you have this discount. It's a risk, certainly. You know, so that, keep that in mind. That's kind of why you're seeing that. But if that doesn't happen, you know, if that doesn't, I mean, even if there is an invasion, but even if they don't delist Sberbank, even if it sells off, I mean, what, it's going to sell off to 1 times earnings or 2 times earnings, you know, if it's banned, that's a different situation. You know, it could be a complete loss of capital. I don't know how that would play out. But if not, there it is. So, hopefully that's helpful. I just wanted to show my portfolio here, one of the accounts. You know, I think last month I was at 1,281,000, so almost 1.3. I think right now I'm 1 and change, so I'm down, you know, 120,000. And you notice I say that without like, woe is me, you know. I mean, and again, I do this often, but it's worth repeating in a situation like this. You can see last year 359 to 203. So you see in the panic of 2020, you know, 156,000, but I didn't panic. You know, I was actually making a fortune, as you can see, because what I was doing is I was buying things at the time that I felt were the most undervalued. So I was buying cruise stocks. I was buying hotels. I was buying ETF jets because I didn't think the world was going to end. A lot of people thought the world was going to end. Capitalism was going to end. All commerce was going to end. I didn't. And so what I'm looking for here is looking at individual stocks like I just showed that are trading undervalued now. If they continue to sell off, they'll even be more undervalued. And particular sectors that are most affected by that particular crash. And that's kind of what I look for. I learned that in a way from Carl Icahn. You know, so there it is. So anyways, guys, it's getting a little long, almost at 23 minutes. Hopefully that information is helpful to you, and you can kind of look at what Grantham and other perma bears are saying, what I'm saying, and others, and make your own assessments and judgments. Take care, guys. Ciao.